Well, good morning, and what better way to start the day than talking to Merryn Somerset Webb. She is a writer who makes reading about investment a joy, no matter what the markets are doing. Merryn, you're joining us from Edinburgh today. How are you?
I'm very well indeed, thank you. The sun is shining here. 19 degrees yesterday. Looks like it's 13 or 14 outside today. So, that's rather nice. We're all
Brilliant.
well.
Bring on climate change, I say. We're going to be talking a bit
We'll get onto that
about
later.
that later. But before we kick off, this is a session as much for you to ask Merryn questions as it is for me to ask her questions. So do use the chat function to the right of your screen. Just keep putting the questions in. Don't wait until the end because we've only got half an hour. The best questions are put to Merryn. But I'm going to start off with a couple of my own, starting with topics that are things that we know our readers are worried about, and then moving on to investment ideas for the future to give them a bit of positive inspo for the days and weeks ahead. So let's start with the markets, as always. Now, we've bounced back from COVID, certainly where we were a year ago, those depressing days, but top of the list for concerns for investors now, of course, is have things bounced back a bit too much. So, Merryn, if it's not too rude to ask, have you taken any profits from your portfolio?
I have taken some profits recently. Yes, I have. And I've taken them in the obvious areas, things that have gone up, exponentially. I had something in my portfolio that's gone up 1,700% since I bought it. And I looked at that and I thought, well, maybe sell some of it. And then there's things such as Scottish Mortgage, which I know an awful lot of our watchers will have. And that's something that, again, has gone up so much. The stocks in there have done so well. You look at that and you think, well, actually, maybe I can trim that and move it into something more value orientated. The way to look at this at the moment is to say, basically everything is expensive. There is almost nothing cheap left in stock markets, but where the real price rises have been is in that sector of the market. And this has begun to change now, by the way, but until recently, that sector of the market that has benefited so much from lockdown, call it the Zoom economy, call it what you like, but these tech stocks that some of them are loss-making, some of them are not, but they're not exactly providing you with an income, but they are benefiting hugely from the way the economy has been the last year, the pandemic-driven lockdown. Those stocks you might look at and say, do I want to have them? Now we're moving into a different environment, a vaccine-driven recovery. Particularly, I think that people should be looking at, and I did write about this a while ago, looking at some of their passive holdings, because if you hold any global passive fund or any US passive fund, you have a very large amount of your money in maybe 6 stocks. So if you hold, for example, an S&P 500 ETF, you will find that something like 20, 23, 24% of your assets are in 6 tech stocks, 6 very expensive tech stocks. If you hold a global fund, you'll still find that 10, 15% of your money is in those same 6 very expensive stocks. So I think now is a really good time for everyone to sit down and say, wow, I've probably made an awful lot of money since March. This was not expected. Now some of the stuff in my portfolio is extremely expensive. Perhaps it's time to look at what offers more value. And there's a lot of talk in there. Stop me talking when you want to, Claire. But the big conversation in the market at the moment is this rotation from growth to value, from stuff that is expensive but growing to stuff that is cheap but maybe not growing, going to continue? And my view is that it is. And one of the things I've written about a lot over the last 6 months or so is where the best value in the world is. And rather wonderfully, it's here at home. The FTSE 100 is probably the most value-orientated market in the world. So, that's where I'm looking at the moment.
Okay, we'll talk a little bit more about the UK in a minute, but let's stay with the things that people are worried about for one more question. Now, in your recent FT Money column, you looked at bonds and the role that bonds have played traditionally over the past decades in people's portfolios as kind of a shock absorber of risk. But what worries you about bonds is that, they're no longer going to perform that function, but all of these, old sort of stock market almanacs, if you like, the mottos of having a 60-40 portfolio in terms of the equity to bond ratio, these things are not going to be so relevant going into the future for investors.
Well, it looks a bit like that. I mean, this is a really interesting one because you say traditionally this is the way bonds have behaved, but it's really only the last 40 years. Back in the 1970s, everyone talked about bonds in terms of them offering you return-free risk rather than the other way around. So this is a change that's happened over the last 40 years. And it's made a lot of sense and it's worked brilliantly. If you were never going to take your money out of the markets at all ever, you would only hold equities. And you wouldn't hold any bonds anyway because equities are the best performer over the very long term. But the problem for all of us is that at some point during our investing career, we're going to need our money back. So over the last 40 years, what we've done is we've held a percentage of our assets in bonds, which has acted as a kind of stabilizer. We think we don't lose money in bonds. We're going to get our money back. It's going to be fine. So we use that as a stabilizer. We reduce the volatility of our portfolios. And then when we want to take our money out, we know there's going to be a reasonable amount of it there. We're not going to be taking everything out in one of the really nasty periods for equities alone. But what happens if bonds stop acting as a stabilizer inside your portfolio? Because what we've seen over the last 40 years is bond prices going up when equity prices go down, and that feels great. But if the yield on bonds is so low that you're not getting much income and there's not much room for price appreciation either, and if, as this happened several times recently, they don't move in opposite directions to equities, but move in tandem with equities, they're not making things any better. They might be making things worse. So we need to stop and look at how our assets are allocated. And this takes me back again to what I just said, that in many cases, your assets are allocated reasonably passively, and they end up in things that you don't necessarily expect. So one of the things that I said in a column a few weeks ago was, by the way, if you hold Scottish mortgage, you also hold Bitcoin because you hold Bitcoin via Tesla. Did you know that? And if you hold your investments in any kind of lifestyle fund, or if it's with any kind of pension, you will probably find that you hold an awful lot of bonds. Is that still a good idea? Something you need to think about.
Brilliant response there. Now, in terms of the alternatives for people who are thinking, okay, so I'll have less of this, less of that, but what should they have more of? Now, number one on your watch list, of course, is UK stocks, as you've just said, but I'm going to throw in one of the first reader questions that's come in on that, which mentions the B word, so gird yourself. Do you still believe Brexit will be beneficial to the UK economy and small investors, asks a reader.
Well, yes, I do. I mean, I think what I always said about Brexit was that I wasn't convinced it would, over the long run, make that much difference. There were lots of reasons to vote for Brexit, but, some sudden boom in the UK economy wasn't necessarily it. But that it wouldn't, over the long term, make a very significant difference to us. It would make a mild positive difference. And I still think that. And, everything that's happening at the moment, various disruptions, etc., we can still call those teething problems unless they're still going on in 10 years, at which point I will throw my hands up and say, okay, that's too long for teething problems. But right now, yes, I'm still perfectly confident in the position I took on Brexit at the time. And I think that the fact that it has now been resolved, that we are there, that we are out the other end of it, is something that will be good for the UK as a whole. I mean, I'm going to go back now to the FTSE 100 and to the value growth shift. If there is a market in the world that says to you, recovery trade, inflation trade, coming out of COVID trade, it is the UK market. I mean, the German market, the DAX, is fairly orientated in that direction as well. But the UK is sort of bizarrely cheap. We're still below the level we were in 1999. Every other market has soared way above that. If we'd kept pace with the other major indices around the world, we'd be well over 10,000, heading for 15,000 by now. If you look at what is in this index, it's all the things that should do well from here. So, miners, energy, banks, healthcare, etc. They're not particularly expensive. They offer you something of a yield. And no, we really still need yields. We can pretend we don't, but we do still need a yield. There was a wonderful cartoon someone showed me the other day of a young person looking up to an older person and saying, these dividends you speak of, where did they used to come from? They're still out there. But a lot of them are in the UK. So, that's now that foreign investors can and will come back because they can see that our vaccine program has been hugely successful because Brexit is slightly out of the way, don't have to worry about it anymore. I think we will begin to see people coming back into this market, and we are already.
Now, the FTSE 100, obviously lots of big multinational companies there, listed in the UK, but active all over the world.
Yeah.
If we go a step lower to the FTSE 250, you've obviously got a lot of British companies in there that are very exposed to the pandemic. I'm thinking about commercial property, I'm thinking about retail, physical retail in particular. Now, the valuations of stocks like that has kind of gone almost beyond bargain basement level, and not to mention the kind of investment trusts that invest in those sorts of shares. But are you as confident about the potential recovery of that sector of the market, or is that something that makes you feel a bit more nervous?
Well, interestingly, I was actually talking to one of the investment trusts yesterday that is invested in retail warehouses, retail parks and offices across the UK. And we had a very interesting conversation about it. I mean, so you remember that when you say they're bargain basement, these things have already bounced back massively. There were investment trusts back in March last year, this time last year, that were trading at 50% discounts to their net asset value. And we were looking at them as though they were never going to collect any rents again. But in fact, rents for particularly out of town retail. So, those big retail parks that in many ways have stayed open throughout the whole pandemic, the places that have the big supermarkets, that have the DIY stores, B&Q, this kind of thing, Pets at Home, where we all still go. I certainly do anyway. Our rabbits get jolly hungry. Everyone has still been able to use these shops and they've stayed open. They also have, facilities for click and collect and big airy shops, etc., that people maybe feel more comfortable going to. So there is a difference, and there is going to be a difference going forward, it looks like, between high street retail, which is going to continue to suffer, I suspect, in the same way that it has been for the last decade. We've seen this trend happening, a shift from the high street out to the retail parks, and that, like so many of the things that we've seen during COVID, this has accelerated as a result of it. Things that people thought would take 10 years for these shops to leave the high streets and head for the retail parks are happening much faster. So actually, I look at those areas and I think, well, I'm kind of convinced on that. This is going to be okay. They're collecting their rents. The shops have stayed open for much of the pandemic. They will definitely be opening properly soon. Lots of the brands that we used to think of high street are beginning to move to retail parks. So Marks and Spencer being a classic. The retail park just down from me is a huge Marks and Spencer's in it, but the Marks and Spencer's on our high street is probably not going to make it. So retail is not dead. Physical retail is not dead. It's just shifting. We still like to shop, and don't forget that in the UK, shopping is a leisure activity for many people. And actually, I've never thought of shopping as a leisure activity myself, but I'm beginning to come round to the idea that just simply meandering around a shop of my choice, buying stuff that I fancy on a whim, might be something I might in future look at as a leisure activity as well. And then you have offices. I mean, this is another matter altogether. Are people going to go back to offices in the same way that they were in before, pre-pandemic? Now, in April, May last year, I would have said that I firmly believed that everybody would go back to the office in exactly the same way. But it's been a year now, a year of working from home. And, habits form and ideas change. So I think that is a slightly dodgier area. Are people going to need less office space in future than they have done? Yes, probably. But on the other hand, prices of office property already reflect that.
Brilliant. Okay, well, we've got some really good questions coming in from people watching at home. If you haven't put yours yet, then please, to the right of your screen, do submit it. Merryn, I'm going to ask you one about Europe before we move on to talk about ESG. So this is from a viewer who says, do you think that also emerging markets, do you think that the main potential might be in emerging markets and Europe as they will take more time to vaccinate?
Well, they're definitely taking more time to vaccinate. There's no doubt about that, is there? I don't think I want to go into European politics right now. There are pockets of value in Europe, definitely. One of the interesting things that has happened over the last couple of years is that while people have been looking at the UK and saying, oh, I don't want to touch that with a barge pole, it's, they've got their Brexit and they're not doing very well with the vaccine, etc. This is all a nightmare, don't touch it. There's also been a view emerging of Europe as, bureaucratic, difficult to deal with, filled with the same kind of nasty old companies that we have in the UK. But of course, actually, there are huge parts of Europe, like everywhere, that are incredibly entrepreneurial. There are, smaller companies in Europe are undervalued. Under-researched to a large degree, which makes a lot of them undervalued. There's lots of brilliant activity in Italy and France and Spain, everywhere. So, just like in the UK, there's this overlay of the stereotypical European company, and then there is the underlay of creativity and entrepreneurialism that we have here as well. So there are some, as readers will know, I used to be on the board of a European smaller companies investment trust, and I've seen a lot of fantastic companies in Europe over the years with them, and so I'm a great believer in the creativity and entrepreneurialism underlying the sclerotic bureaucracy.
Okay, well, let's move on to ESG now, as we're halfway through the session. Keep feeding me questions if you want to get yours in. Now, we've got some really big sessions ahead at the festival today about climate change. Notably, Gillian Tett, your old mucker, will be talking to Mark Carney, formerly of the Bank of England, now on a mission to...
Oh, she gets all the good gigs.
to save the planet. Now, ESG investing is an issue that all investors are very concerned about, but younger investors particularly. Now, you've argued in your column, somewhat controversially, as is your tendency, that actually, chucking out these big oil companies from your portfolio may actually not be the right thing to do, even if you are a person who is worried about climate change.
Mm-hmm. And I absolutely think that. I mean, there's so much greenwashing going on at the moment, and the whole subject of what is ESG, what isn't ESG, what is good behavior, what is bad behavior, how do we define it, what metrics do we use, etc. is hugely fraught and hugely nuanced. But there is a sort of general view from the man on the street that you look at companies that you might consider bad, and the good thing to do is just not invest your money in bad companies. And so that's fossil fuels, it's mining. So you say, well, they're dirty, they're environmentally unsound. You can't possibly want something that is good for the planet and also hold these filthy companies. So that's the general view. And then you look at it and you think, well, actually, I think it's a bit more complicated than that. If I sell all my shares in an oil company, what am I actually doing apart from making myself feel good and maybe making myself look good to other people? And the answer is basically, nothing good. Nothing good at all. I mean, one thing that you might do is make it harder for them to raise new money. You might think that's a good thing because then they won't go and invest in more nasty, dirty mines and nasty, dirty oil, etc. But a lot of these companies, they don't need money anyway. They're not in the business of raising money. They're just in the business of running their business. So all that happens when you sell their shares is that their shares get cheaper and the business simply carries on. Nothing else happens. And if you make the shares cheaper, then what happens? Somebody else will buy them. And that somebody else may not care at all about the climate, may not care at all about the environment, may not care at all about polluted water. So they're not going to put any pressure on the company at all. Now take it a step further. What if those shares really do get very cheap indeed, too cheap? And then maybe you run a pension fund, or maybe you're an individual, maybe you run a university endowment, whatever. You look at it, but you are too good a person to buy back those cheap shares. So what happens? Maybe a private equity company comes along, maybe one based in a nice developing country, maybe one based somewhere else, and takes that oil company private. And now you've got someone who maybe really isn't interested in any of the environmental stuff that you and I might worry about. And not only that, but is no longer dealing with a listed company. So the transparency and the regulatory oversight is also no longer there. Have you done anything good here? Or have you actually done something really quite bad, particularly when we need the fossil fuels? Sure, transition to cleaner energy is underway, and it would be nice if it was even faster than it is, but whatever we do is going to take quite a few decades, if it's ever complete, right? And in the meantime, we need those fossil fuels. We need traditional sources of energy. And it doesn't matter how cross we get with oil isn't going to go away. And same with mining. If we want to get rid of the combustion engine, and if there are any readers who would like us to keep the combustion engine, we would love to hear from them. In the main, everybody says, we're done with combustion engines. I don't want to see any more diesel on the streets, right? I want to see any petrol on the streets. If you're going to do that, do you know what you need? Mountains of copper, mountains. and mountains of rare earth metals. You've got to have lithium. You have to have all these things that are not particularly clean and easy to mine. And if you have to have those things, we should be doing the best we possibly can to make sure that we have those things produced in the most sustainable way possible. And as I think I said in the column, flouncing off in a huff and pretending it's nothing to do with you is not the correct way forward. The correct way forward is not to hold less of these things, it's to hold more of these things. As if you're a responsible person, you should want to buy as much of this stuff as you can get your hands on. And then you should be working very hard to make sure that no water sources around these mines are polluted, that communities around these mines are looked after properly, et cetera, et cetera. You know, I don't think this is complicated. And I am absolutely bemused by the we should divest view. This is nothing to do with me. People say, I'm going to keep the heating on in my house. I'm going to keep using plastic bags. I'm going to keep driving my car around the block. I'm going to keep, signing up for holidays abroad, et cetera. But own these companies? Oh, not me. I'll leave those nice men at the private equity companies because they'll do it better than I will. But I can tell you what, they won't. Sorry, did you want to rant or did you want a short answer?
I was very much enjoying that. I'm just going to read out one line from the last column that you wrote, which was the cacophony of ostentatious do-goodery, which did make me smile.
I'd add one more thing to that, by the way, is that if you are, for example, the manager of a big pension fund, you have one responsibility first, one responsibility that comes ahead of all the others. Your job is to do the best you possibly can to make sure that the living standards of the people whose money you are stewarding is as good as they can possibly be on their retirement. And those people may not thank you. In fact, you may have not lived up to your responsibilities if you say to yourself, well, I'm going to invest in the bubble in renewable energy instead of in the value that exists in existing energy sources.
Indeed, and the dividends that they throw off, and the green bubble, as it's becoming known, is something that really has been an extraordinary story during the pandemic. But obviously, it's not the only bubble. People.
No, but can I just say on the green bubble that we love bubbles. Bubbles in this context are an absolutely fantastic thing, because do we need a renewable energy revolution? Well, of course we do. And is it wonderful that lots of money is going into it? Absolutely. That's what bubbles do. They provide the finance for transformative change. They overpay for it, think railways, etc. But FT readers don't have to be in that bubble. Somebody else can finance it.
Oh, you're so cheeky, Merryn. That's why we love you. So before we move on, we've got some great questions from people who are new to investing, which I'm going to come to shortly. But let's very quickly talk about Bitcoin, because this obviously is a really, really hot topic right now. It's also one that lots of younger readers especially are interested in. Now, you hold Bitcoin, which may shock some people watching.
Of course I do. Of course I do. I'm a very open-minded person, Claire. And so, I hold Bitcoin via my remaining holding in Scottish Mortgage, which of course holds Tesla, which of course has a lot of Bitcoin, etc. But I also hold some Bitcoin directly on Coinbase. And I do that for the same reasons that I've continued to hold tech companies that I've believed to be horribly overpriced for the last 5, 6, 7 years, because I'm very often wrong. And when I looked at Bitcoin initially, I didn't get it. I don't understand the point. I might understand blockchain and I might understand the point of cryptocurrencies, but then do I understand why it would be that Bitcoin would be the winner in the cryptocurrency world? I mean, there are 1,500 cryptocurrencies. Why Bitcoin? And I don't buy the idea that Bitcoin is another kind of gold. I'm not sure I buy the idea that it's a particularly effective money, because what we want from money in the main is stability, not insane volatility. And what do we have with Bitcoin? We have insane volatility. I'm not even sure that I buy the idea that it has value because of the network effect. The idea that if lots of people use it, it automatically has value, because the more people use it, the more demand for it there is. But each Bitcoin can be divided to infinity. So there's no actual shortage. There might be a limited number of whole Bitcoins, but there's no shortage of fractional Bitcoins. So there's lots of reasons why I look at Bitcoin and say, I really don't get this. But on the other hand, there's a lot of really, really clever people I know who tell me that they do get it. So I have a small direct holding in Bitcoin on Coinbase, which I can promise you, is not worth hacking, okay? Not worth hacking. Don't even try. And that means that if Bitcoin goes to the moon, if it goes to $1 million, I'm not going to be really, really upset because I've got a small stake in the game. And if it collapses, you know, my children will probably still eat. And I think that is the way to approach an investment in Bitcoin at the moment. We don't know. It's interesting. And, you know, money is transforming. Money is transforming. There is a revolution coming in the ideas around what is money, what does money do, how is money supposed to work, does the state have a monopoly on money, can you have private money? By the way, no, private money almost never works, which is another reason to be slightly leery of Bitcoin. Private money is not something that tends to come with a particularly long history. So yes, I do have Bitcoin is the answer, and I will just keep it and see what happens.
Okay, two questions I'm going to throw in from new investors. Welcome, new investors. Do buy FT Money in the FT Weekend newspaper every Saturday, so you can read Merryn and me, of course. Now, one person haven't invested before, they are looking to transfer their cash ISA to a stocks and shares ISA and would like some tips. And then somebody else hasn't invested in investment trusts before and wonders if you could also give some tips about how to choose an investment trust. You've got 4 minutes, and then I'm going to ask you about what's in your column tomorrow.
Okay. Starting out, cash ISA to stocks and shares ISA. Gosh, you are so lucky. There is so much choice in the UK. So much choice. All the platforms offer good, cheap ISA wrappers for this. Once you've opened your ISA wrapper and you're ready to invest, I mean, there is so much. I mean, offer tips from the entire market. Really hard. What I do is I have a core portfolio of 6 investment trusts that I really like and that I think provide a balanced, diversified portfolio for the core of my money. And in there, I have, obviously, I have Scottish Mortgage. We talked about that because I want to be exposed to that growth that I don't always believe in terms of value, but which I believe in terms of the future. And then I have, inside that, I have some of the investment trusts that are very stable and aim to protect your money as much as to grow it. So personal assets, RUFA, RIT, that kind of trust. And then I have exposure to UK value, which, as I said earlier, is an area that I feel, you know, is the place to be at the moment. So Temple Bar, which is an investment trust that has had the most awful time over the last year, the most awful because it lost its manager, it's been in the wrong sector, it holds some of these filthy stocks we were talking about earlier, but which I have reasonable expectations of for the future. Lord Debenture, another investment trust that I like a lot. You know, I think that's the way to go for it if you're just starting out. I really, really don't think that people starting out as investors should try and build their own portfolios of individual stocks. I think it's incredibly difficult to do. I think it's incredibly time consuming, and it's really, for the amateur and indeed for anybody, it's very risky. And I know there is a big argument about whether, you know, one should pay active fund managers or not to do this job for you. I still think that it's something that one should probably do. The fund management industry gets an awful lot of stick, but if its core purpose is simply to invest your money in a really reasonably diversified way and hang on to it at an increasingly low cost, then they're doing a perfectly good job.
Well, thanks for sharing that.
Does that cover both those things?
A small disclaimer: neither Merryn nor I are financial advisors, so this is a discussion about what you could do, but ultimately, you know, it's on you. You've got to make those decisions, and if you need some help, obviously, you can go to an independent financial advisor to hold your hand. Now, finally,
absolutely true, and I will say that a lot of any of the investment trusts, etc., that I talk about, I tend to mention in my columns as well. So that's a better place to go and get more information about them.
That's right, and I will tweet out some links to those columns later. There's some very good ones which I can call to mind instantly. Now, for the final 2 minutes of our session, will you tell us, Merryn, about what is in your column tomorrow? Because it's quite a consumery story, which is getting going.
I've written about Deliveroo, which is hopefully going to list on the UK market in the next few weeks. So we're pleased it's going to list in the UK. It's going to be one of the biggest listings we've had for a long time. But the really interesting thing about it is that if you are a client of Deliveroo, you can apply for shares. Now, in the great scheme of things, it's only £50 million worth of shares, and the business is expected to be valued at something like £7 billion. So not a huge amount of shares available to retail investors. But if you are a client, you can go and apply for shares, which I'm very pleased about, because I'm a great advocate of shareholder democracy, the idea that retail investors that we all should be both invested in the stock market and engaged with our investment in the stock market. And retail investors, ordinary investors, have often left out of new listings. These institutional investors get to be in them. Same with secondary listings. When companies come to raise more money, it's very often that, the professional investors get in, and we don't. And very often, you make quite a lot of money out of a new IPO. Very often you don't, by the way. Very often you don't. There's an awful lot of examples of losing a whole load of money on buying shares when they're listed. But I'm pleased that we have the opportunity to do this. And I'm pleased in particular because the last year has seen a huge wave of new young investors come into the market. And this is the kind of brand that people already know, they already understand. And so it's a great way to get started in the market, owning a few shares in a company that you already know about, as long as you don't pay too much for them. And by the way, we don't know yet what price Deliveroo will be listed at.
Fantastic. Quick final question. What's your favourite place to order from on Deliveroo?
Ooh, well, actually, there's a pizza place just down the road from us called Matto that does brilliant sort of artisanal pizza, which I can't eat because I have celiac disease, but my children say is absolutely amazing. So that's become our go-to place. I'm sorry, that's not much use to those of you who do not live in my neighbourhood.
Well, it's lovely to get this insight into your life as an investor and your life in Edinburgh. Thank you so much for joining us today, Merryn Somerset Webb. Read her column in tomorrow's FT Money, all about the Deliveroo IPO. And if you want to see more of what we're writing about, follow us on Twitter and Instagram. I'm at Claer B. Merryn is at Merryn SW for Somerset Webb. Thank you, Merryn.
Thank you.